Welcome to this explainer. Today, we are going to completely transform how you look at your investments. Seriously, we're stripping away the emotion, the hype, all those rumors you hear from your neighbors, and we're going to demystify fund selection using pure, hard data. If you've ever felt totally overwhelmed by the sheer number of options out there, or just frustrated by your portfolio's performance, well, you are in the exact right place. So let's just get right into it. I want you to start by asking yourself a really honest question. Why is your portfolio barely moving? Like, why might your mutual fund returns be stuck at a dismal 2 to 5%? You're basically getting basic fixed deposit numbers, all while the broader market is booming and creating immense wealth for everyone else. It is incredibly frustrating, isn't it? You check your investing app and see those tiny single digits, but then you hear your peers talking about pulling in 20 or even 30% returns. Okay, let's dive into this, because that massive, painful gap between your portfolio and theirs, it usually boils down to just two fundamental errors: bad fund selection and bad investor behavior. That's it. It's absolutely not about luck, it's just a flawed process. And today, we're going to fix that process for good. So here is our roadmap for the journey today. We'll start with the low return traps, then move into aligning time and risk. After that, we'll cover professional filtering metrics, evaluating the fund portfolio, and finally wrap up with 4 rules for investors. We're going to systematically build a highly professional, data-backed approach for you. Starting with part 1, the low return traps. It is time to stop chasing miracles. Before we can even learn how to pick the right funds, we have to stop picking the wrong ones, right? The very first massive mistake retail investors make right out of the gate is falling for the fad trap. This is when you invest your hard-earned money based on whatever's trending in the news or blowing up on social media. Remember between 2021 and 2023 when literally everyone was hyping up quant funds, or when PSU funds were handing out 90 to 100% returns? People chase them like crazy. But what happens next? Usually, dead silence. Chasing whatever happens to be trending just leaves you holding a stagnant, underperforming portfolio when the market season inevitably shifts. And that brings us to the second trap: ignoring mean reversion. This is just the brutal reality of the markets. A lot of investors simply open up their app, sort by the highest one-year return, and blindly throw their money into the number one fund. But here is the thing. In almost 90 to 95% of cases, last year's top-performing asset class will actually see diminished, flat, or even negative returns for the following 2 to 3 years. Point-to-point one-year returns are, quite frankly, a terrible way to pick a long-term investment. Moving to part 2, aligning time and risk. Let's do a quick internal audit. So if we know we can't just pick the top trending fund, where do we start? Well, we start with an internal audit of your timeline. Before you look at a single mutual fund, you must first look at your own goals. The absolute first question to ask yourself is, when do I actually need this money? If it's for, say, a house down payment in less than 3 years, you completely avoid equity. Why? Because the market can drop 30% at any time. Stick to liquid or debt funds. If your horizon is 3 to 5 years, you want capital protection with a little bit of growth, making hybrid or balanced advantage funds key. And as your timeline stretches beyond 7 to 10 years for things like retirement, that's when you can move aggressively into pure equity, multi-cap, or flexi-cap funds. The ultimate purpose of the money dictates the financial instrument, period. But time is only half the equation. The other half, it's your stomach. Let's do a really quick hypothetical scenario. Imagine the market crashes tomorrow. Your portfolio drops 30%, deep into the red. It's bleeding. How do you honestly react? Do you panic? Do you freeze? This single gut check reveals your true investor profile. Your emotional reaction directly maps to your risk capacity. Think about it. If a market drop makes you want to immediately stop your SIPs and withdraw everything, you are a low-risk investor. And that's fine. You just need to stick to hybrid or debt funds where the drawdowns are much smaller. If you calmly continue your SIPs like nothing happened, you're moderate risk. Multi- or flexi-cap funds are your sweet spot. But if you see that sea of red and your immediate instinct is to increase your SIPs or inject a lump sum because stocks are on sale, you have a high-risk appetite, and you can absolutely handle the crazy volatility of small and mid-cap funds. Now, what's really interesting about this is how regulations actually step in to enforce diversification for you. If you're eyeing pure equity for the long haul, you might find yourself debating between a multi-cap and a flexi-cap fund. Well, SEBI rules mandate that a multi-cap fund mathematically must hold at least 25% in large cap, 25% in mid cap, and 25% in small cap, leaving the last 25% completely flexible. This forced discipline means you always have exposure across all market caps. Flexi caps, on the other hand, let the manager do pretty much whatever they want. And why does that specific structure matter so much? Because of this massive number, 50 lakh rupees. Historically speaking, the structured diversification of multicaps has delivered about a 2 to 2.5% superior return compared to flexi caps. To put that into perspective, over a 20-year period, if you're running an SIP of 10,000 rupees a month, that seemingly tiny 2% difference turns a 1 crore rupee portfolio into a 1.5 crore rupee portfolio. The specific category you choose has unbelievable long-term wealth implications. All right, moving into part 3, filtering with professional metrics. It's time to ditch the star ratings. Okay, so we have our target category. Now we need to find the specific fund, and we do this by completely ignoring consumer star ratings and using actual professional metrics. Because let's face it, a 5-star fund today could easily become a 2-star fund in 3 years. We need consistency. The absolute first metric you must look at is rolling returns. Point-to-point returns just tell you what happened from one random day to another. But rolling returns, they take every single possible entry date over a 10-year period and average out the 3-year or 5-year returns. It literally removes luck from the equation and exposes the true, undeniable historical performance trend of the fund. Next up, you've got to measure the ride. Basically, will this fund give you a heart attack? You check beta for this. If it's less than 1.0, the fund is less volatile than the overall market. Then look at standard deviation. A range of 13 to 16 means acceptable, manageable risk. If it's spiking over 20, you're taking on way too much risk for the expected return. And finally, the Sharpe ratio. Think of this as your risk-adjusted return. If one fund gives 15% and another gives 17%, but the first one has a much higher Sharpe ratio, it's actually the superior choice. Why? Because it took far less risk to get you those gains. Let's move to part 4, evaluating the fund portfolio. We're looking under the hood now. You've checked the historical performance, you've checked the volatility metrics. Now it's time to evaluate the actual fund portfolio to make sure it's structurally sound and truly diversified. When you crack open the portfolio, say we're looking at something like an Axis Multicap as a quick demo, you want to see more than 60 stocks to avoid concentration risk. You want those investments spread across 8 or more different sectors. Now, a massive red flag to watch out for is overlapping sectors. If a fund has 30% in private banks and 25% in financials, actually, scratch that, that's not diversification at all. That's just a massive bet on one single segment of the economy. Also, ensure your expense ratio for direct plans is sitting under 1.2%, and definitely double-check that your fund manager actually has a solid track record of 2 to 3 years or more. And please pay close attention to the assets under management, or AUM. You are really looking for the Goldilocks zone here, between 3,000 and 15,000 crores. If the fund is too small, it hasn't quite earned the trust of peers yet. But if it's massive, like well beyond 15,000 crores, it loses its flexibility and agility. The fund manager starts having a really hard time deploying all that capital effectively. This specific range, it's the perfectly balanced sweet spot. Finally, part 5, 4 rules for investors. This is the behavioral twist. So, the crucial point is, and this is the absolute climax of our explainer today, you can follow every single analytical step we just discussed perfectly. You can find this statistically flawless fund, but none of it matters without this next part. Even the greatest mutual fund in the world will fail to make you wealthy if you panic. So, here are the 4 non-negotiable rules for your behavior. Rule number 1, stop obsessing over finding the quote-unquote perfect fund. Just pick a decent one that passes our filters and get started. Rule 2, commit. Stick with that exact same fund for one full 5 to 7 year market cycle. Bouncing from fund to fund is just going to eat up your capital and exit loads and taxes. Rule 3, treat market dips like a massive discount. If your net asset value drops by 20%, you are getting the exact same great assets on sale, so buy heavily. Do not stop your SIPs. And rule 4, as your salary grows, scale up your SIP amount annually. 5,000 rupees a month shouldn't be your limit forever. Ultimately, what I really want you to take away from this explainer is this exact thought. Investing is not about the financial instrument, it is entirely about your behavior. All the data is out there, the framework is incredibly clear, but long-term wealth, that is purely a test of your own psychology. So what's it going to be? Will you keep chasing fads, or will you stick to the data and trust the process? Thank you so much for watching, and I truly hope this framework changes the way you invest forever.